If there is one thing I have learned after a lifetime around money, it is that most systems do not reward good intentions. They reward correct behavior inside their own rules. That is a very different thing. A great many people believe the financial world is judging them in real time, almost like a living moral witness. They think that if they behave responsibly, the system immediately recognizes the responsibility. They imagine that if they use a credit card carefully, if they have the cash in the bank, if they pay the full balance the moment the bill arrives, then the machinery must naturally record them as prudent, disciplined, and low risk. That is not how the machinery works. The machinery is colder than that. It is bureaucratic. It takes photographs, and if you do not understand when the photograph is taken, you can do everything that feels right and still hand the algorithm an image of yourself that looks reckless. That is one of the strangest features of modern finance. People are not always being punished for being irresponsible. Quite often they are being punished for not understanding the reporting calendar. That sounds too small to matter. It matters enormously, because once you begin treating the financial system as a set of snapshots rather than as a live moral judgment, many mysteries disappear. Why does a perfectly responsible person see a sudden drop in his credit score after paying his balance in full? Why do people with cash still get scored as if they are overextended? Why does a person feel clean in his bank account and still appear messy in the bureau file? The answer is that the financial world is not watching the room after you clean it. It is often photographing the room before you clean it. I want to explain that as plainly as I know how, because millions of people are losing points, borrowing power, and peace of mind simply because they have been taught to focus on the wrong date. The average household has been trained from childhood to believe that the due date is the sacred date. Pay by the due date, avoid late fees, avoid interest, be responsible. That is good advice as far as it goes, but it does not go far enough. Paying by the due date protects you from one kind of pain. It does not necessarily present you to the scoring system in the strongest possible light. That is the missing lesson. The due date matters for money lost. The statement closing date matters for the picture sent to the bureaus. If you confuse those two, the whole system feels unfair. The reason it feels unfair is simple. You are playing one game while the algorithm is scoring another. Suppose you have a card with a $5,000 limit. You spend $2,000 on furniture. You are not being reckless. You have the cash. You intend to pay in full. You wait for the bill to arrive, and when it arrives, you pay every cent. No interest, no late fee, no moral stain on your own conscience, and then the phone buzzes. Your score fell 25 points. A person who does not understand the plumbing immediately reaches for the wrong explanations. Maybe the system is rigged. Maybe credit cards are inherently dangerous. Maybe using them at all is some kind of trap. The reality is stranger and simpler. The system did not judge your payment date first. It judged your reported balance first, and the reported balance often came from the moment before you paid. That is why responsible people keep getting confused. They think they are living in a live feed. The bureaus are often working from a monthly photograph. That is the entire trick. Once you understand that the game is built on monthly photographs, the behavior changes. Imagine a typical billing cycle from the first day of the month to the 30th. You use the card during that time. Groceries, gas, a dinner out, an appliance, school supplies, whatever life required. The balance climbs throughout the cycle. That statement is not just a bill for your convenience. It is often the key data point the issuer sends to the credit bureaus. That balance, the number on that statement, becomes the version of you that the scoring system sees for that month. The due date, which may not arrive for another 3 weeks, is a different event entirely. The due date decides whether you pay interest, whether you are late, whether you incur fees. The statement closing date often decides what utilization the system records. This distinction is so important that I would put it in large letters over the desk of every young adult in the country. The due date protects your cash. The closing date shapes your score. Most people are taught only the first half. Then they wonder why the second half keeps ambushing them. This is not some fringe technicality. Utilization is one of the fastest moving components of the credit scoring system. Payment history takes years to build. Inquiries take time to fade. Length of history takes patience. Utilization can change almost immediately once a new statement balance is reported. That means it can hurt quickly and heal quickly. For that reason alone, it deserves more respect than it gets. The scoring models are not especially interested in your personal intentions. They are interested in ratios. How much of your available revolving credit are you using? That is the basic calculation. If you owe $500 on a $1,000 limit, you are using 50%. If you owe $100 on the same limit, you are using 10%. The model sees those two situations very differently, even if both people intend to pay in full by the due date. Intent is not the metric. Utilization is. That is why I say the system rewards behavior inside its own rules. You may be morally prudent and still mechanically inefficient. The system does not care. The scoring models were designed not to admire your good heart, but to estimate risk. Historically, people who run high balances relative to their limits are more likely to default. So the score responds rapidly when the reported ratio rises. This does not mean the system thinks you are a bad person. It means you look riskier under its cold, compressed math. That is why crossing certain thresholds can feel so punishing. Above 30% utilization, the model often begins treating you as materially weaker. Above 50%, the picture worsens. Near the limit, the system starts behaving as if some form of stress may already be present. And here is where it gets especially irritating for responsible people. You can trip those thresholds without ever paying a cent of interest. A person can be wealthy, liquid, and disciplined. Yet if the statement cuts while the balance is high, the report still shows heavy usage. That is what creates the psychological disconnect. Your bank account shows you are fine. Your credit file shows something less flattering. You feel responsible. The report looks stretched. That contradiction has frightened many people away from understanding credit cards properly. They conclude the tool itself is evil. Usually the user simply did not understand when the snapshot was taken. Once you do understand, the solution is not dramatic, it is timing. Instead of paying only after the bill is issued, you make a payment before the statement closes. You clean the room before the photographer arrives. That is the whole strategy. If the statement closes on the 30th, you may want the balance already reduced 3 or 4 days before then. Not because the due date demands it, because the report will likely reflect the statement balance, not the later payment. If you had $3,000 outstanding on a card and you pay it down before the statement cuts, so that only a tiny amount remains, then the bureaus receive the tiny amount, not the ugly prepayment number. Now the picture changes. Nothing dishonest happened. You did not fake a payment. You did not borrow less than you borrowed. You simply learned when the system takes its picture and arranged your payment timing accordingly. This is often described as a hack. I dislike that word. It sounds as though you are breaking the system. You are not breaking anything. You are finally learning the schedule of a machine that was always there. In finance, a great many so. Called hacks are really just basic literacy that the public never received. This is one of them. Now, some people hear all of this and ask the natural question, does it really matter if the statement shows $1,000 or $10, so long as the bill gets paid? Yes, it matters. The scoring models are more sensitive to utilization than most people appreciate. A large share of your score is tied to amounts owed, and utilization is the central driver there. That makes it one of the fastest levers available to ordinary people. This is why I always tell people to respect the variables that can be moved quickly. A missed payment is hard to repair. Length of history cannot be rushed. Utilization can be improved on the next cycle. That is powerful. And because it has little memory in the most widely used models, last month's ugly number does not have to haunt you for years. A high reported balance in January can be followed by a much better reported balance in February, and the model largely moves on. That is a wonderful feature if you know how to use it. It also means people should stop treating utilization damage as a life sentence, not a permanent wound. Now, there is another myth that needs killing. Many people assume the ideal outcome is a zero balance on every card at every statement close. That sounds logical. If low utilization is good, zero must be perfect. Not necessarily. The models are trying to evaluate how you handle credit, not whether you are a monk who never touches it. A small reported balance followed by can actually be more useful than a perfectly sterile series of $0 statements. Why? Because the system sees activity plus restraint. You are demonstrating use without stress. This is different from carrying a balance and paying interest. People confuse those ideas all the time. Reporting a small balance is not the same thing as carrying a balance into interest-bearing territory. If the statement closes with $10 and you pay that $10 by the due date, you owe no interest. The bureaus still saw activity. The scoring system saw very low utilization. That is often ideal. This is why some people use what is sometimes called all zero except one. Most cards report zero. One card reports a tiny amount, not because a tiny amount makes you richer, because it gives the model a clean, active, low. None of this is morally profound. It is just competent use of the rules. I want to emphasize that because many adults were taught to see credit as either saintly or sinful. That is childish thinking. Credit is a tool like most tools. It behaves well in the hands of someone who understands the mechanism and behaves badly in the hands of someone who does not. The real goal is not to fear the tool. It is to become literate enough that the tool serves you. That is one reason I like simple explanations tied to daily behavior. Find the closing date for each card, not the due date, the closing date. Put it somewhere visible. On a calendar in your phone, on a piece of paper. If you prefer paper to screens, then a few days before that closing date, look at the live balance. If it is too high relative to the limit, and you care about your score for an upcoming mortgage, auto loan, or general credit quality, push it down before the statement is generated. Not after before. That one shift changes the picture materially. You are no longer letting the bank choose the moment of your public photograph based on the ugliest part of the monthly cycle. You are managing the photograph. That is not trickery. That is adulthood. What I find fascinating is how many intelligent people never learn this because they outsource the whole process to autopay. Autopay is a fine servant and a poor master. It is useful for avoiding late fees. It is not designed to optimize your score. If autopay is set to pay the statement balance on the due date, then by definition, it is working too late to influence the reported statement balance that already went to the bureaus. This is why a person can feel incredibly responsible and still produce mediocre utilization snapshots month after month. Autopay kept the account current. It did not shape the report. For many people, that distinction explains years of confusion. They thought they were doing everything right because they never missed a payment. From an interest and fee perspective, perhaps they were from a reporting. Timing perspective, they were passive. And passive people often accept the least flattering version of themselves in financial systems without realizing they had another option. There is, however, a line between intelligent timing and suspicious behavior. This is where people must be careful. If you repeatedly run a card to the limit, pay it down, run it back up, pay it down, and cycle far more spending through the card than the bank intended for that limit, you may trigger risk systems of a different kind. Banks do not only watch your reported statement balance, they also watch patterns. If you turn a $1,000 limit into $3,000 of spending every month by paying and reusing constantly, you may appear unusual enough that the bank becomes uncomfortable. That kind of credit cycling can attract scrutiny, account reviews, or even closures in some cases. Why? Because the issuer granted you a certain level of exposure, and if your behavior suggests you are effectively trying to create a much larger working line through repeated repayment inside one cycle, the institution may decide the pattern is outside its comfort zone. This is where prudence matters. I do not want you gaming the system so aggressively that the bank begins treating you like a fraud risk. If you constantly need more room than your limit allows, the proper move is often not another clever timing trick. It is a request for a higher credit limit. A larger limit can make excellent utilization almost automatic. Spend $2,000 on a $20,000 limit, and you are using 10%. Spend $2,000 on a $5,000 limit, and the ratio is far less flattering. The denominator matters. That is why old, unused credit lines often deserve more respect than the public gives them. People close cards because they want to simplify their life or because they do not like the look of open accounts they seldom touch. Sometimes that is sensible. Often it is a scoring mistake. Available credit is part of the denominator in your overall utilization ratio. Close a card with a healthy limit and the denominator shrinks. Now, the same amount of debt produces a higher ratio. Nothing changed about your spending. The picture worsened anyway. This is one of the many reasons I dislike financial decisions made only for emotional neatness. Neatness can be expensive. If an old card has no annual fee, little management burden, and a decent limit, it may be worth keeping open, perhaps with one small recurring charge and automatic full payment, simply because it keeps the denominator generous and your profile older and steadier. Again, this is not glamorous. It is structural. I have always preferred structural advantages to dramatic ones. The structural advantages are the ones that keep paying quietly. Now, there is one more layer worth understanding. Some newer scoring models look not only at the current snapshot, but also at the trend of your balances over time. That means a person who constantly runs huge balances and then slashes them right before the closing date may not look as perfect under future models as under the older ones. That is fine. It should not frighten you. Because the adult answer has never been constant manipulation for its own sake. The adult answer is genuine low risk behavior plus informed timing. Do not live at the edge and then pretend one small payment trick will save you forever. That is not what I am advocating. I am advocating something much more respectable. Use credit lightly relative to your limits. Pay in full, avoid interest, maintain old lines sensibly. Then, when you have an important application approaching, or you simply want your report to reflect your best reality, manage the statement date intentionally. That is not deception. That is synchronization. You are bringing your real responsible behavior and the system's recorded version of it closer together. That is a very worthwhile thing to do. This whole topic reminds me of a larger truth. The financial system is built on dates, definitions, snapshots, categories, and rules that most ordinary people were never taught clearly. The people who understand those rules are not always morally superior. They are often simply more informed, and informed people save money, preserve borrowing power, and move through institutions with less friction. That is why I care about these small mechanics. A great many fortunes are not lost only through bad investments. They are also lost through repeated small misunderstandings of structure. The person who pays needless interest because he does not know the grace period, the person who lets utilization spike because he does not know the statement date, the person who closes old cards because he thinks zero accounts is cleaner than well-managed capacity. The person who ignores limit increases and then keeps looking stressed relative to the lines he has. None of these errors sound cinematic. That is exactly why they compound. What looks trivial once can look expensive when repeated over years. I do not want that for you. I would rather you understand the mechanism so well that your score is no longer some mysterious mood ring glowing red without explanation. A score should not be worshipped, but it should be managed intelligently because it affects the price at which you can borrow for things that truly matter. A lower mortgage rate over a long life can be worth a great deal. A better auto loan price when needed matters. Even certain insurance and approval systems can be influenced indirectly by the overall health of your credit file. That means this is not a toy variable. It has consequences. And if the consequences are real, then the mechanics deserve respect. So here is what I would do. I would stop thinking only about the due date. I would find the statement closing dates. I would pay down balances before the statement cuts whenever I cared about the reported picture. I would aim for low utilization, ideally below 10% most of the time, and lower if I were polishing the file ahead of a major application. I would not obsess over zero everywhere every month, but I would keep the profile conservative and active. I would leave older useful cards open. I would avoid cycling so aggressively that I invite trouble. And above all, I would stop feeling victimized by a system whose calendar I had simply never been shown. That is what maturity often is in finance, not discovering that the system is kind, discovering that the system is mechanical. Once you know the machinery, you stop taking normal outcomes, personally. You start adjusting your behavior to fit the rules that actually govern the result. That is a much calmer way to live, and calm in money is always worth more than people think. You do not need to outsmart the system by inventing tricks the system never anticipated. You need to understand the timetable well enough that you stop handing it the wrong photograph of your life. That is a very achievable improvement. And sometimes, in finance, the most valuable changes are not dramatic at all. They are simply the removal of an unnecessary self-inflicted wound. This is one of those. If you make the timing change and keep the rest of your behavior sound, your score can improve not because you became a different person, but because the system finally began recording the right version of the person you already were. That is a fine outcome. It is one I would gladly take, because the world is expensive enough without letting a calendar misunderstanding make it more so.